Hello, fellow meteorologists. We are talking about, is winter coming? Before this, it was basically the chat was, when is winter coming? How cold is it going to be? Seems to be the general feeling. We have a consultant, we have a company founder, we have a VC. You guys have a number of different angles on this. Let's start with Peter.
A butterfly just landed on your head. That's got to be a good sign.
Oh, hey, good luck.
Apparently spring is here.
yeah, maybe it's already over. So Peter, tell us here, how bad is it going to get? Loaded question.
So I think the scary thing is there are a lot of reasons why you could doubt winter's coming, right? I mean, when winter comes, it comes from two sides. It either comes from access to capital or it comes from demand from your customers. And if you take a look at those two sides, access to capital, VCs, growth PE, they are raising record funds. Some people can point to Q3 and say, was there a huge downturn in the amount of money put out? The number of VCs I talked to that basically said, I killed it the first half of the year and we thought about shutting down for the rest of the year. I took the whole summer off and then just raised triple the amount of money I wanted. And the reality is I think there may not necessarily be all of the indicators we want in that Q3 downturn. And then the other side, globally, a lot of the customers in the enterprise space are already in a crap state. Outside of the US, a lot of the demand is already hindered. So is there a lot of downside there? And so these are things that could make you question it. The reality, though, is it will be coming. Maybe we want to all tell ourselves the consumer side is going to be walled off and it's going to be left to those guys. But it could come from that, could come from things that we just cannot even think of. I think we all feel it in our bones. So the question, I think, is how do you prepare for that? And I think we've got a couple of guys here and we had some great conversations that we'll be able to get into some of the thinking on that.
Yeah, great. Jack, what do you feel in your joints as far as the funding environment
I'm not
goes?
an investor. I'm an operator. I'm the CEO of a company called Smartling, and while I'm not making investments, so I don't know whether whether the downturn is here or whether it's 3 months from now, 6 months from now. But when I sort of look at the cycles of every market has cycles. Are we in a bubble? Who knows? But if you look at sort of a downturn in 2001, a downturn in 2008, we're in 2015. Where are we? To use an American metaphor, are we in the 7th inning? Are we in the 8th inning? Are we in the 9th inning? My sense is that there's more of a conservative feeling to it. My sense is that I'm seeing some of our customers that are disappearing overnight, and even though they had terrific tech press and they were one of the darlings or whatever, that they've had substantial problems. My sense also is we have some of our clients that are buying some of my other clients right now. Some of my huge clients are buying some of the smaller ones. So I sense that there is something happening here. And so from an operational perspective, we're starting to think about how do we winterize the company? How do we be very thoughtful about the fact that if there is a downturn, either on the supply side or on the buy side, on the demand side, what do we do about it?
Yeah.
How can we be properly prepared?
Great. We'll come back to that. Andy, the VC, you get the last word on this. You are, in fact, you saw some silver linings to this when we were talking earlier.
Yeah, absolutely. So I'm a partner at SoftTech VC. We're an early stage seed fund based in San Francisco. We've been telling all of our founders that winter absolutely is coming. Like Jack said, we don't know when, we don't know how long it's going to be. But now is the time for companies to start thinking about how they begin to operate slightly more conservatively. I think 2 years ago we used to talk about GAP, growth at any price. Companies that were spending 2 years worth of revenue to acquire a customer. That's just not going to fly anymore, because what every company has to think about, not only what does their cash flow look like, but also what do their core metrics need to look like to go on and raise that next round. Every venture-backed business is going to need more money to succeed. They're going to be thinking about what does that A or that B round look like, and unless they have their customer acquisition cost, unless they have their margins looking healthy, then they're going to be basically screwed. And what's going to happen is the corpses of these companies will be kind of littering the streets. And as the point I made to you earlier is that lots of great companies can be formed in downturns. Good companies can do fine in great conditions, but only great companies can do well in downturns. And the advantages they have is they can hire cheaply. People can live in the cities cheaply. They can get office space cheaply. And we haven't begun to see that yet, but it will happen.
Okay, and so you as a VC scanning the horizon, you see a lot of opportunities still. This is not a total wipeout as far as
we've been talking about the kind of the tremors in the macroeconomy, what happened in China last month, leading to some contractions in the later stage markets. But for us, we're seeing as many great companies as we we ever have. And the good news is, as a startup, it's actually cheaper now to build a great business than it ever has been. I think the challenge is just not going too crazy. Keep the costs under control.
Yeah.
Don't hire that super expensive salesperson until you have the sales process figured out. And maybe kind of think about that weird old-fashioned notion of actually being profitable.
Okay,
Maybe.
yeah, exactly. But Jack, to that point, when we're doing risk management, when we're winterizing our companies, as you said, that means you don't get a pass on growth, right?
No, you definitely don't get a pass on growth. I mean, growth is everything. Growth shuts everybody up. Growth is, and I think when growth tends to slow, it may be some sort of TAM market fundamental issue, but more often than not, it's probably a self-inflicted wound, which means some sort of execution issue around this. But no, I think that I think that growth is definitely something that every company has to achieve, but being thoughtful about how do I prepare myself for the coming winter by doing larger deals with bigger brands for 1, 2, 3-year terms up front, cash up front. That can allow you to still achieve growth. Maybe sales cycles increase. This is the enterprise forum, so from an enterprise perspective, maybe the sales cycles increase. But there's a lot of companies out up in the startup alley out there that would love to have a $500,000 funding round when you're selling a $150,000 a year enterprise platform on a 3-year deal paid up front. Guess what that is? That's a funding event. It's called sales. Should occur every single month.
And you don't have to deal with idiots like me.
Amen.
Peter, you ran through earlier to me a sort of ranking of what companies need to think about in this type of environment. As we said, stage 1, stage 0 is growth. You have to grow. But beyond that, there was a number of things that you were rattling off that the company should really think about now that maybe gets lost in the sort of frenzy of gap of growth at all costs.
Well, and I think the funny thing is, actually, it goes back to what you guys were already saying, which is that companies that do good on the metrics that all of our investors are looking for already are the ones that are going to survive, right? So we've taken all software companies back to 1980, both public market ones and a ton of private market information through some VCs that we have partnerships with. And certainly growth is the only thing that correlates to valuation, right? If you put that in. Now, if you remove that as a confounding variable, what you see are the things that they pound us on all the time, right? The first, do your margins actually look like software margins? Are you getting 75, 80% gross margins on your product? Those companies that are in those cases where you might have 40 or 60% because you got a really heavy install, really heavy support, you start to have cash crunch issues, right? That's going to spill over in this market. The second is, what's your sales efficiency? What's your customer acquisition payback period? Great companies in terms of valuation, certainly on the enterprise side, less than a year you'd like to have. Certainly you can maybe get higher than that and not get quite the same valuation. Or if you're in the SMB, you want 6 to 9 months because of some of the structural issues of the SMB market. Again, if you are able to get to that level and you get paid up front and you keep that customer for a long period of time, in many ways you can fund yourself for your growth. The third wouldn't be surprising. It tends to be the churn metrics, right? So if you're on the enterprise side, you want your gross churn to be running, less than 1% a month or 10% a year, or your logo churn. And if you're SMB, certainly that's going to be higher for structural reasons in that market. It can get up to 20%. But again, if you're able to keep those customers, you're not dragging the boat anchor. And so even in the downturn, a lot of people are going to continue to pay you money, and you need to take that cash in. And honestly, the really surprising one was a bit counterintuitive, and we worked with about 25 VCs on evaluating these. The last one was a greater emphasis on logo expansion than on existing customer expansion. And that's not to say that you can't prove and have to prove that you can actually get it out of your existing customers. But your proof that you can win new customers, helps demonstrate that you're not TAM capped, that you've got really good hunters out in their market. Because in a downturn, you can always fall back on expanding your existing customer base, but you need to be preparing by being the squirrel that's collecting as many nuts as possible today.
Yeah, absolutely. I mean, in my previous life as an entrepreneur, we were selling enterprise software, and the kind of best practice that we adhered to, which was really the Salesforce playbook, was every month you expect 50% of revenue to come from new business and 50% of revenue to come from expand business inside existing customers. And what's nice is, as economic conditions change, you can change that needle around, but that's a good place to shoot for because, you want to prove that you can take an existing customer and upsell them. That's where the real long-term value is. But at the same time, most customers will tap out at some point, so you need to have new logos coming in all the time.
And so from your investment perspective, are there any metrics that are going into your screen now that weren't there before? What's exciting you now in this market that you talked about earlier, that there's going to be some fallout?
Yeah, I mean, we invest so early that that a lot of the metrics simply may not even exist. Sometimes we just invest in a team that we know who we know can create great technology, and we believe they'll go and do it. If it's a team we don't know, then we're looking for and this is such a bullshit VC term, but we're looking for like early indications of traction, which is a useless throwaway line that means something different in every deal that we do in every VC that talks about
it when you see
But
it.
for me, what I'm looking for is early signs that customers absolutely love the tool, that they will pay for it. They'll go from monthly payments to an annual payment to a yearly payment, like multi-year payment, like Jack talked about, and that we think there's a market big enough to sustain a business that can go on to be doing hundreds of millions of dollars in revenue. The nice thing is, as a firm, we'll make 20 investments or so a year, of which probably maybe 8 to 10 will be B2B and SaaS. So we can take a few bets in there as well in companies that we don't know exactly where it's going to go, but we think they have that potential.
Okay.
But by the way, it's something that you had talked about earlier. I feel like sometimes we're scared of the downturn, but the point that we were talking about, the crazy thing is downturns actually can create sales efficiency and make it easier to hire great people, right?
Absolutely. That's
right.
If you're a great company, you are able to hit all of those metrics, you are in a position then to sweep up all the talent you weren't able to before. Customer acquisition costs, one of the largest reasons that it's expensive, has nothing to do with your fundamental ability to do it. It has to do with the churn of your salespeople. Like, what is your churn at? How many new people do you have? In a downturn, a lot of those guys stay around, and then all of a sudden you end up in a much better situation. So it may not be something to be scared of, but rather, are you prepared for it? Because if you're in that great situation, you have a strategic advantage relative to others in the market, and you can actually create one of those lasting value companies.
So your company was born in the previous winter, let's say.
That's right.
2009.
2009.
Deep freeze.
Yep.
And so I mean, there's companies here who are much younger than that. What can you tell them about this?
Well, definitely we started the company in 2009. Lehman Brothers just disappeared. Bear Stearns just disappeared. That was sort of shocking economic environment, and it was very difficult to raise any kind of angel funding because the concern was that if I invest $50,000 or $100,000, I mean this is back when angel funding was in the six figures. Now angel funding is like $18 million, right? But back in those days, there was concern that if I put money into your company, there may not be a Series A to follow on, and even though you may have a great product idea, execution, vision, et cetera, there may not be follow-on money. But I also think that great companies always look for ways to get more lean, no matter what the conditions are, and to be thoughtful about how they're spending. And again, since this is the enterprise forum, I think most enterprise companies tend to think in terms of CAC and non-CAC. CAC meaning cost to acquire customer, all of your marketing and sales spend. And on a personal level, I'm much more willing to spend in CAC as long as it's leading to the right growth. And I want to be more lean on non-CAC. I think anybody that's ever worked with a really elite team, whether it's the U.S. military or that's the military. I was a military pilot for 10 years with the U.S. military. Whether you're an elite athlete on a sports team or whether you're with a high-growth, venture-backed startup, a leanness inspires creativity. The constraint provides a way for people to say, we've got to solve this problem, and we don't have additional resources to do it, and guess what? You come up with additional ideas from here. So I think smart companies, no matter what the environment, whether it's 2009, whether it's 2015, whether there is a downturn at some point 6 months to 2 years in the future, great companies are always looking for ways to cut fat out of the organization and to get more efficient.
Well, I think Larry Ellison said, if you're not selling and if you're not building, what the fuck are you doing?
Well, and one thing I'd love to actually ask both of you guys, because I feel like some of our conversation is slightly conceptual right now, and I'll relay one example, but I'd love to know what are some of just the very practical things that you think you can do to just get some of that efficiency. So for instance, one CEO that I thought gave a really nice answer. I was sitting with the CEO of Click Software who sold it recently, and he basically said, too many times we think about, getting efficiency and getting good as being a step change. Like, we've got to do something big. But he said, honestly, it's the small things that you do that can actually get you there. And he said, for instance, on CAC, all I did was I asked my team every quarter, I want you to Pareto the deals that we did this last quarter and ask ourselves, what portion of those could we have done with a lower cost of acquisition? It doesn't necessarily mean getting them all to digital, right, which would be a huge leap in doing big enterprise deals, but could I have done some of these inside? Could I have done some of them with my BDR or customer success team? Could I have done some of them through my marketing organization? He's like, to be quite honest, I might only have gotten 2% or 4% better every quarter, but you do that for 2 or 3 years, and all of a sudden you have a market-leading engine. And so I love that just from a very practical management thing. Have you guys seen other things that work in your organizations?
I totally agree.
Yeah, I mean, I think that there's the very obvious things you can do, and I think startups, and I would count myself in as criminal in here, is that we do a lot of vanity marketing. We do things that actually don't need to be done. You don't need to go to that trade show. You probably don't need to hire that PR company on retainer. You don't need to run that PR stunt. And that's a great thing to do when you've got a ton of cash in the bank, and times are frothy, and you can win kind of column inches like that. But I think what every company needs to be thinking about is every dollar that I spend now on marketing, is that going to generate $2 in sales? Is that going to go on, for the lifetime of that customer, is that going to be worth $10 or $15? Because if it's not, you should cut it out. Look at your sales org and your marketing org. Unless the people are delivering, and actually delivering either actionable leads for the sales teams or salespeople that are actually closing those leads for revenues, get rid of them. And it's hard, and I think that one of the things that we went through in around 2008, and this was prompted by one of our VCs, was don't be afraid to cut. And if you're going to cut too deep, because no entrepreneur has ever said, oh, I wish I'd cut just a little bit more shallow, because I wish I should have left just a little bit more fat on there. You can always rehire if you need to, but it's a lot harder to get rid of people. So if you're going to do it quickly.
Yeah, Jack, you were talking about non-acquisition costs. Are there any sort of items that you could say, if you're going to prioritize it? Are there any sort of things that...
I think it's company specific. I just know that my bias is whenever I think about, every tech team wants more developers, every client service team wants more implementers, pre and post sales, every finance person wants more people in the G&A department. And I would just, if I have to, my bias is, I always think that people can be more efficient, and that constraint will breed creativity, but I don't want to, as much as possible, have our marketers and salespeople fighting with one hand behind their back. But I am a fan of, as Peter mentioned, sort of the 1% improvements. Can we generate 1% more leads every month or every quarter or whatever? Can we dramatically, by just focusing a little bit of a 1 or 2 or 3% improvement, can we drive our average sales price up over a period of time? When you can make small adjustments in the lead flow, in the pipeline creation, and driving that ASP up, including multi-year deals, cash up front, I mean, man, that just absolves a lot of sin. And when you hear sort of salespeople saying well, I would have sold it except that the product needed this one feature that we don't have, I mean, that's a bullshit answer. I mean, we've been selling this thing for 6 years, right? That's the job of the salesperson, is to articulate value and find a way to make that solution the right solution for them.
And I think it's a good point on the salespeople. I think what we have to realize is that, and no offense to salespeople in the room, but they can often be very coin operated. And you can tweak that 5 to 10% improvement in sales value by offering spiffs, offering prizes. Whoever, who's the first to close a 100K deal this month gets this big ass TV that we bought, which is currently in the office. Hit your target, for 3 months, and we'll send you to Disneyland. And it's incredible how well those can work, and how motivating they are for the salespeople as well.
This all sounds quite simple. Sort of winter is coming. This is going to be scorched earth. You mix all the metaphors. The unicorns are collapsed in the field, et cetera, et cetera. I mean, but this sounds like sort of common sense that should always be happening. Why should we be worried?
Well, and I'll throw out 2 other ideas, and I think it goes to the worry, right? When we're in fat times, we can get away with doing things inefficiently. That's the worry, right? And 2 other just often very simple things that we've observed is, one is that we tend to lose focus. We get 40 growth paths and we try to pursue them all. Whereas organizations that get much more focused and choosy about the ones they do tend to get much more efficient. And they say, I am not going to quota you, sales guy, for actually selling into this organization. You need to be only selling in what we're going to be doing. All of a sudden you get up with. So part of it's focus. And then the other side is there are certain things that we have been able to just put up with that are broken, like pricing. The funny thing is we've got 225 growth stage SaaS companies that we've been benchmarking. And one of the questions we asked them was, how did you set your prices? 2/3 came back with an answer that was something akin to, I guessed. The point is like if you are dragging some of these obvious boat anchors into a bad market, that's when you're going to get killed. And so it's just some of those very practical things of the 1% getting better, the making sure that you're not, spread yourself too thin because you've been in a fat market, and you address just some of the basic, fundamentals of the business.
But I think the really key thing, and this is, especially key for everybody in the audience here, is that, we're all building real businesses with customers and revenue. And whilst winter may be coming, you guys have the comfort of having this nice umbrella of a real business to support it. I think, if we were sitting on the consumer stage and we were talking about, how on earth we're going to monetize our photo sharing apps, then I think we'd be really worried. But, to your point, it's just doing sensible things. It's not overhiring. It's not overspending. It's not going for those fancy offices. It's just building a good growth business.
Yeah. Jack, final word from you.
Yeah, I think when you said, is this easy? No, I think it's hard. I think building a great business is literally one of the hardest things that you can do on the planet. But I think that people always think about by the way, this butterfly has landed on every single one of us.
It's spring.
In the middle of the winter is coming. Clearly we are completely fucking wrong. I think that when people think about sort of success, it always looks like this. Oh, it was a rocket ship from here to here. But in reality, it is a twist and turn that has occurred along the way every single time. And so being thoughtful about, hey, my growth just slowed. What does that mean? What happened? Or our CAC payback just increased dramatically. Our efficiency, just decreased dramatically. And trying to solve that, being smart and curious and thoughtful about it, really is how you make something like that work.
Well, I'm sorry we ran out of time. It was a really great discussion. Thank you guys, Andy, Jack, and Peter, and thanks for listening.
Thank you.
Thank you.